you are really persistent, and if you're constantly trying to achieve something, it will happen in your life.
The global economy is unpredictable, and if you're not navigating market volatility with the right strategies, you're missing out. From diversification to adaptive investing, there are opportunities hidden in the chaos. Don't let fear of missing out hold you back. Learn how to take control of your financial future today and thrive in uncertain times. Understanding market volatility. Market volatility refers to the frequent and often unpredictable changes in the value of assets in financial markets. In 2008, the global economy faced a severe downturn, causing massive market fluctuations, which led to many investors losing significant amounts. Fast forward to 2020, and the pandemic caused another wave of volatility, affecting stocks, commodities, and currencies worldwide. The impact of these fluctuations is felt by both seasoned investors and newcomers alike. While market volatility can be unsettling, it can also present opportunities for those who are prepared. Understanding what drives these changes, like economic shifts, geopolitical events, or natural disasters, helps investors make more informed decisions and reduce risks. Through diversification, hedging, and staying informed, investors can weather these ups and downs with confidence. A key risk management tool. Diversification is a powerful strategy to manage risk in volatile markets. By spreading investments across various asset classes like stocks, bonds, real estate, and commodities, investors reduce the impact of a poor-performing asset. For example, during the 2008 financial crisis, investors who held diversified portfolios saw less damage than those who concentrated only on stocks. Similarly, in 2020, despite market turbulence due to the pandemic, those with diversified portfolios were better equipped to manage losses. Diversification doesn't guarantee profits, but it helps balance risk and return over time. In volatile times, it's important to regularly review and adjust your portfolio to maintain a strong, well-rounded investment strategy. Adaptive investment approaches. In volatile markets, adaptive investment approaches are essential. These strategies involve adjusting your portfolio to respond to changing market conditions. For instance, in 2020, many investors shifted to safer assets like bonds and gold when the pandemic caused uncertainty. Adaptive investors carefully monitor economic trends, company performance, and global events, using this information to make timely adjustments. The goal is to minimize losses during market downturns and seize opportunities when conditions improve. By staying flexible, adaptive investors can navigate volatility with greater confidence. This approach requires constant learning and staying up to date, ensuring your investment strategy evolves with the market's ever-changing landscape. Utilizing exchange-traded funds. Exchange-traded funds, ETFs, have become popular tools for investing in volatile markets. ETFs allow investors to buy a diversified portfolio of stocks or bonds in a single trade. For example, during the 2020 market crash, many investors turned to ETFs to spread their risk across different sectors. ETFs are a great way to gain exposure to markets or industries without putting all your money in one place. They also offer liquidity, meaning they can be bought or sold throughout the day like stocks. However, it's essential to research the underlying assets and risks involved before investing. With the right strategy, ETFs can provide a solid foundation for managing risk in unpredictable times. Incorporating alternative assets. Incorporating alternative assets into your portfolio can be a smart move during volatile times. Alternative investments, such as real estate, commodities like gold, and private equity, are often less correlated to traditional stock markets. For instance, gold has long been considered a safe haven during economic downturns. In 2020, while global stock markets were plunging due to the pandemic, gold prices soared as investors sought stability. Real estate, too, can offer steady returns even in uncertain times. However, alternative assets come with their own risks, such as liquidity issues or high entry costs. By diversifying into alternatives, investors can better shield themselves from volatility and achieve a balanced portfolio. Hedging strategies to mitigate risks. Hedging is a strategy used to protect investments from market volatility by taking opposing positions in related assets. For example, during 2020 when stock markets were shaky due to the pandemic, many investors turned to options and futures contracts to hedge against potential losses. Hedging can also involve using assets like gold or even currencies to offset risks in stock portfolios. While hedging can reduce potential losses, It also comes with costs, such as transaction fees or the possibility of limiting profits. Understanding when and how to hedge is crucial, as a well-executed hedge can offer peace of mind, especially during unpredictable market swings. The role of behavioral finance in investment decisions. Behavioral finance examines how psychological factors influence investors' decisions. In volatile markets, emotions like fear or greed can lead to irrational choices. For instance, during the 2008 financial crisis, many investors panicked and sold off stocks at a loss driven by fear, while others held on to underperforming assets, hoping for a rebound. Cognitive biases, such as confirmation bias, where investors seek information that confirms their beliefs, can also skew decision-making. Understanding these biases is key to making better investment choices. By staying aware of emotional impulses and sticking to a disciplined strategy, investors can avoid costly mistakes and navigate market volatility more effectively. The importance of continuous learning. In volatile markets, staying informed is crucial to making well-timed investment decisions. Economic indicators, company earnings reports, and global news all play significant roles in market fluctuations. For example, in 2020, the global pandemic caused dramatic shifts in the economy, and investors who kept up with health updates and government responses were able to adjust their portfolios accordingly. Utilizing financial news, research tools, and market analysis helps investors stay ahead of the curve. Continuous learning through webinars, books, or financial education courses can enhance investment strategies, ensuring that you're always equipped with the knowledge to adapt to new market trends and opportunities. Long-term versus short-term investment strategies. Long-term and short-term investment strategies offer different advantages, especially in volatile markets. Long-term investors, who focus on holding assets for years or decades, often weather market fluctuations better. For example, despite the 2008 financial crisis, investors who stuck to long-term strategies saw their portfolios recover over time. On the other hand, short-term investors might capitalize on immediate market opportunities but face higher risks and stress, especially during downturns. In 2020, many short-term traders took advantage of sudden stock swings, but those who tried to time the market faced challenges. A balanced approach, combining both strategies based on personal goals and risk tolerance, often provides the most stability and growth potential. When and how to seek professional guidance, consulting a financial advisor can be a wise choice, especially during times of market volatility. Advisors offer expert insights and personalized strategies, helping investors navigate complex financial decisions. For example, during the 2020 pandemic, many investors turned to advisors to help adjust their portfolios in response to sudden economic changes. A good financial advisor can provide guidance on asset allocation, risk management, and tax strategies. When choosing an advisor, it's essential to check their qualifications, experience, and fees. Seeking professional advice ensures you're making informed choices, and with the right advisor, you can develop a strategy that aligns with your financial goals and risk tolerance. Don't miss our next video, The Power of Compounding: How Small Investments Yield Big Returns, where we'll show you how small moves today can lead to massive rewards. Hit that subscribe button so you never miss out on tips that could transform your financial future. Stay tuned, success starts with the right knowledge.